Good morning, friends. Today's speaker has shared the case study, which I have done screen sharing. Request all the participants to go through the case study.
Hi, Subhajit. So you seem to be having sunlight a little bit earlier than us.
Yeah, it's cloudy, quite cloudy over here.
Mm-hmm.
How about Bangalore?
Bangalore's good weather. Very nice.
Good. I wish to be there.
Always welcome. Morning, Shilpa.
Morning. Hope all the participants have studied the case study. Shall I share it in the chat as well?
Yeah, I think that would be good.
Good morning to all. Good morning, Shilpa.
Good morning, sir.
Good morning.
Good morning. Good morning, Devendranath.
Good morning.
Shilpa, we'll start with it's a few minutes early, but maybe we'll just start with the introduction.
No, we can wait. Let others join.
Okay, sure.
For 2 minutes, 8 o'clock we'll start.
So, Mr. Lucas, where are you based at?
I'm originally from Kottayam, now here in Calicut for around now 7 years.
Okay.
Before that, I was in Chennai for 9 years.
Okay.
So what about you?
Oh, we are Bangalore based, sir.
Okay.
So some of us are Bangalore based. Subhajit, for instance, is from Calcutta. Many of our participants are from other parts of the country. So, for instance, we have people from Ahmedabad, from Mumbai, from Pune. So it's from Chennai also. So when we see Mr. Delhi,
Sabu is from Cochin.
Yeah, Sabu is from Cochin. So we have Mayur, for instance, is Pune. Mayur is Pune, right?
Yes.
Yeah.
Yes, sir.
Sir, you missed Delhi. I'm from Delhi.
Yeah,
Oh,
so
okay.
Delhi, not to be left out. Okay, Shilpa, we'll start with the introductions.
Yeah,
Is
I
that
will
okay?
do the honors, sir. So good morning, friends. Let's start the session. On this occasion, we have Professor Jijo. He's a faculty at IIM Calicut, and he has got his PhD from IIT Bombay, Masters in Finance from Cochin University of Science and Technology, and he's a member of the Institute of Cost Accountants of India, and he's done his BCom from MG University. And his research areas for which he got his PhD was for empirical corporate finance, empirical asset pricing, and market-based accounting research. And also he was a professor at IFMR Chennai and associate professor at IIM Tishnopalli. His research papers on corporate finance, International Conference on Financial Markets and Corporate Finance, and corporate derivatives use, leverage, and cost equity. The new insights from Indian non-financial firms won the best research paper award for him. And today he's going to help us to understand the leverage buyouts analysis. He's also going to give us an Excel model and also a practical case study. Over to you, Professor.
Okay, thank you, Rabindranath. And probably I should first congratulate and this Bangalore Venture Association, Valuation Association. I mean, it's a lot of enthusiasm and energy to be present. So, 8 o'clock in the morning. And essentially, I mean, when Rabindranath requested me for this session, I asked him probably, what is it that of interest to you? So he said, I mean, mostly we are into valuation. So let's discuss something about valuation. And I said, I mean, normally I offer an elective on hedge fund strategy. Why don't we discuss about hedge fund strategies? He said, I mean, okay, but I mean, something pertaining to valuation may be more relevant. But what I observed is you have gone through many aspects of valuation, but probably something like leverage buyout is not something you may not have seen or discussed in detail. See, one of the key reasons why LBOs are not there in the probably discussion or probably in the forefront of discussion in India is the regulatory issues. One issue that you face in India is we have a bank-based system where domestic companies are prohibited from borrowing money to invest in equity. So that means, look at this, look at when Nirma acquired Lafarge's assets in India, it approached some NBFCs. And finally, what Nirma found is they are asking something like 250 basis point more than the rate at which it can raise money through debenture. So banks are not willing to finance leverage buyout. And the second issue that you face is, if you go for the ECB mode, again, ECB mode are not really allowing Indian companies to take loan from outside to invest again in instruments, in equity instruments. So that means essentially one route is probably for foreign LBO partnership firms like KKR or probably Actis Capital to raise money abroad and bring it to probably, SPV floated to acquire an Indian company in the form of probably, equity and convertible debentures. So that, this company that they floated will have the required capital structure. Also, there are issues pertaining to the regulation, income tax rules, which sometimes prohibit companies from probably showing some of these interest, expense deductions. So these are some of the issues. Of course, there was one proposal. The first proposal was to allow LBO structure to acquire distressed companies. This was one of the proposals. Also, there was a lot of discussion about reviving or probably bringing better liquidity to Indian corporate bond market. And so that, as you know, most of the cases, the LBO is associated with the junk bond market. Junk bond market is essentially bonds with no rating or absolutely below investment grade rating. So of course, let's wait. I think regulation is evolving. We may see more and more activities. Now what you observe is, if an Indian company would like to take or probably go and acquire some firm abroad, LBO route is possible. Probably one of the oldest thing that we discuss is Tata's acquisition of Tetley. So essentially, an Indian company can float an SPV in somewhere in UK and then go and buy a company using lot of debt. Sometimes even you can float a foreign entity, get another financial sponsor, raise debt, come back to India and acquire a company with a lot of debt. That is also being permitted. So just before starting this discussion, let's go through an interesting case. This is about, Toys R Us. Toys R Us is a classical example of leverage buyout and a case where LBO failed. Probably then we may move to another example, again, a TXU. We will see this Texas Energy Corporation example. We will go through that. That's again another LBO that failed. Then probably we may take about 5 to 10 minutes understanding acquisition of, Celanese chemicals by Blackstone. That was a big success. So we will go through these three cases and then try to understand how one should make sense of the numbers. So that's going to be probably the agenda for our discussion. Please stop me at any time when you need some kind of clarification or, additional material on, these topics that we are discussing. So,
sir,
yes.
Sir, this is Subbarao. I have a small question. Okay, can you give me a brief introduction about leverage buyout and as well as advantages of that before starting the cases?
So no, I'm not going to the case that I shared with you. I will be first discussing about some examples. Through the examples, I will discuss what is LBO, and then probably we will have a formal discussion. The last 30 minutes or so, we will be discussing the case. So you will get enough introduction.
Sure.
Right.
Sure.
Okay.
Thank you.
Fine. Okay.
Professor, whenever you want, please let me know. I will launch the poll.
Yeah, poll can be launched, sometime later, because some of the questions they may need input on what we are discussing right now. So this is, the heading probably appeared around 6 years back. There was a $6.6 billion acquisition of TR. In fact, KKR is one name that you see quite frequently in leverage buyout. And many of you are interested in leverage buyout transactions. I suggest you to probably read this excellent book or watch movie, Barbarians at the Gate. So that's, something very, very interesting about, the junk bond market and how they are financing the deals, Barbarians at the Gate. So here, I mean, you can see a deal where KKR, along with Bain Capital and a real estate developer, three of them, they are investing equal stake in equity and acquiring a firm. So typically one of the terms that we use is how much you are paying in terms of the EBITDA. So you can see that, I mean, this is 9.9 times the estimated EBITDA for 2005. So this is on the higher side of the valuation, typically. We will see the range soon. So the first point that we see here is, I mean, look at this, the candidate for merger. Toys R Us is essentially a company selling toys. Okay. So you have a ready stream of cash flows. So LBOs are more common in mature industries with steady cash flows, less capital investment, and lower R&D investment. So the idea here is, look at this, the equity purchase price, what they offered is 9.9 times. The transaction is going to be financed with 7 times debt. So essentially, you can see that 7.7 is the total price that you are paying out of, 9.9, 7 is coming from debt. And typically, when a company or an institution is going from the private status to the public status, we call it going private transaction. Going public transaction. So IPO is an example of going public transaction. Quite often, when you have an LBO or MBO, management buyout, the organization is delisted. Therefore, it's known as going private transaction. So these transactions are also known as going private transactions. So the ownership, that means you need to have 100% ownership. This is another problem for a foreign acquirer like KKR to go for an LBO in the Indian market. Look at this, we have the FDI rule. The FDI rule states that you can't have 100% ownership in certain industries. Therefore, if a foreign buyout firm is interested in an Indian company, acquire the same, make some kind of restructuring and unlock the value, and again go back and sell it, that's not possible in many industries due to our FDI rule. So I mean, because 100% ownership is acquired so that you can make it private. And this is, essentially, they have done many successful deals in the past. So that is one of the reasons they were going for this deal. So now, as you know, this is, the company started a strategic review process around 10 years back. And the company found that they are not doing very well. They were facing a lot of problems, both in terms of demand and in terms of operating expenses. And they thought about selling the company through a two-party auction and many other kind of restructuring which they thought about. But of course, when the deal announced roughly, after so many years, what you see here is, they got something like, after, year is what they observe is that they got a price of something like 26.75 rupees. This is a substantial premium. So you can see that, the premium. Typically, the acquirer pays a huge premium to the target company in LBO. Of course, where is this premium comes from? We will discuss that as we progress. But one need to understand what is happening in this industry and probably, what is leading to this firm's failure later on. We will come back to that. But essentially what you observe is that the demand for retail toys were going down substantially. One of the two reasons. One is essentially you have load on online retailers capturing the space. And the second thing is kids are no more using, the traditional toys like, dolls or building sets or blocks. They are more comfortable with video games. So video games are replacing the toys, and also a lot of retail sale was taking place. This is at this point, probably, you need to have a sound understanding of the industry while you are going for a deal like LBOs. So those who are not participating in the discussion, please keep your terminal in mute mode. Okay, that's all right. And another interesting point is you need to look at the demand. Where is the demand coming from? We have seen two factors that's probably acting against the demand. Another interesting point that you notice is the growth in kits in especially in various parts of the world. And you can see that, I mean, this is essentially, I mean, in United States. So you will see that, sorry, all over the world. So essentially that you see is, I mean, the growth rate is extremely low year after year, or I mean, or a 5-year period. If you take the CAGR, the CAGR is roughly only about 1% when it comes to the kids, those who buy toys. And look at the financials of this company. Revenue is more or less stagnant because of the reasons that we already discussed. Competition from online retailers, and probably demand is not stable. So, I mean, you can see these problems. Of course, I mean, this is where somewhere the deal happened, and you can see the numbers here, but essentially the top line is, I mean, almost there, I mean, almost same. And when you look at the EBIT, the operating profit is, again, not improving, it's reducing. So this is at the probably, I mean, the background. So if you look at, I mean, the various divisions of this company, so what you look at, I mean, what you observe is that many of the divisions are not able to report growth. So that is another major problem that you see. I mean, this is for, so please look at this, this should be 2004. And so you will see that many of the divisions are not able to report growth. And the margins are also not very impressive. This is, I mean, at this background only, these three firms, I mean, KKR, Bain Capital, and a reality company together came as equity sponsors. They took debt and acquired this firm. So look at the typical transaction details, how you describe this transaction in detail. So you have the transaction proceeds, essentially, I mean, excluding the fees. And you are, so this is what you are paying. And the approximately the existing debt that you are going to assume. So you take, I mean, the cash on the balance sheet. So this is how we calculate the enterprise value. So how you calculate enterprise value? Equity value, value of equity, value of debt, total debt minus excess cash. You are essentially assuming in the normal scenario minus cash. So this is what you call as the enterprise value. So enterprise value to EBITDA ratio is something like 9.4. With that, you are transaction cost that will give you the total transaction value. Interestingly, some of the cases, this transaction cost is going back to the sponsors in the form of consulting charges and fees. So it's not really an out-of-the-pocket expense. So you will see that KKR may be taking about 100 million. The other sponsors may be taking again about 100 million. Only 62 million may be going out as expenses. But I mean, essentially put together the total transaction value as for, I mean, evaluation is 9.9 times. So another interesting point that you observe here is essentially what type of debt that you are taking. You have different type of debts. So you have secured debt, unsecured debt, and you may have some bridge loan which you promise to pay, what you can say, early. And you have the mortgage loan because, I mean, Toys R Us own a lot of, what you can say, real estate. And so that is why they also got a sponsor who has got expertise in real estate. And so you can see that, I mean, where is the leverage? If you look at, I mean, the existing debt is 3 times. After you factor in all type of debt and deduct the cash on the balance sheet, the leverage is going to be 7 times. So this is what we discussed. So transaction value to EBITDA multiple is something like 9.9 times. And essentially the total debt divided by EBITDA after the transaction is going to be something like 7 times. So this is, I mean, the details pertaining to the deal.
This leverage amount of 6712 is proposed or proposed?
No, this is essentially the borrowing that I mean, this equity partnership that is KKR, Bain and whoever it is, they are used in order to acquire it. It may be done in two ways. Sometimes you may take the entire debt to the balance sheet of the company. So that means the balance sheet of the proposed company essentially means here this is going to be Toys R Us. Some other cases you float a special purpose entity and then use debt and equity of this. I mean, you buy equity of this and transfer or give loan to the target company from the special purpose entity. So the loan may be with the special purpose entity. You may have a holding company, subsidiary company structure, depending upon the taxation in that particular geography. So now you have the typical source and use of funds. Source and use of funds, you have, I mean, the cash on the balance sheet, whatever borrowing that you propose. So together you have so much amount. And you have, I mean, the use of funds, how much you are paying to the equity shareholders, how much you are paying to the other, what you can say, investors. And you can see that, I mean, essentially this will give you the numbers 6566. I hope you are familiar with most of these terms. I mean, essentially, I mean, something settlement of equity, security interest, warrants. I hope you are familiar with the term warrants, share warrants, ESOPs, and employees bonus payments. And because there may be some kind of VRS or some kind of golden parachute associated with mergers that will lead to this kind of payments. I hope most of the terms are familiar to all of you. Any questions here? Okay. So let's move to this. So this is, I mean, after, a couple of years, roughly after 12 years, what you observe here is these three firms lost roughly about 1.3 billion of the equity that they invested in this deal. So they purchased this in something like 2005 or end of 2004 or 5. But interestingly, there are three dimensions in which you create value. We'll come back to that. The first dimension is you ensure better revenue growth. There was no revenue growth for this target company. So this is the first limitation that you see. The second one is probably, I mean, reduction in expenses. So essentially, I mean, you try to get better margin. And the third one is, say you acquire someone at a multiple of something like 7.9 times. You try to sell it at a better multiple, say 10 times. So essentially what you call is, this is the improvement in the multiple. So what you observe here is the sale never went above this number. The what you can say, essentially you acquired this firm at 11 billion and it was in the range of 11 to 12 billion. It never really crossed that limit. And of course, some of these loans are essentially given by KKR and Bain Capital. They were paying the interest, but they were also paying something less advisory fees. But essentially what you can see is most of these investment firms lost a lot of money. In fact, their investment was roughly about 1.3 billion. As you know, when you file for bankruptcy, the equity investors lose their investment in the firm. That is, the summary. We will see what are the factors that led to this. But essentially, this is a case or a classic example of a leverage buyout that failed. So key points that we need to notice here. The first point is, who are the likely target of a leverage buyout? The likely target of a leverage buyout is a firm in the mature industry with a lot of free cash flow so that you can use free cash flow to service the debt. Presently using, probably not much debt. So you can increase the leverage and borrow more. And probably there is scope for some assets which are not really used so that you can sell these assets, liquidate the assets and pay off the debt. And probably there is scope for improvement. Essentially what we call is probably there is some value of control, not in the sense of, the private benefits of control, but in terms of you can bring some improvement in performance. So this is, some of the likely, characteristics of a target. Another interesting example, this is also something that failed. So now you may think that, okay, all the LBOs are failing, so what is the point in going through LBO? No, we will also see an example of LBO that was highly successful. So, but look at this. This is, I mean, the TXU, the Texas Electric Utility Company. So this is probably, I mean, one of the largest LBO in the history, where the amount paid is 32.1, and again it has gone private. So please understand the logic. You have a public company with less amount of debt, you acquire it using lot of debt. I mean, again, this debt is directly or indirectly entering into the balance sheet of the target, and of course after 7 years they file for bankruptcy. So this is what you can see here. So this is, I mean, the deal size, or I mean assets at the time of filing for bankruptcy was 14.9. So please remember, this is, the name is different because, I mean, there was a holding company structure used for acquiring this company. Of course, there were multiple reasons that is being suggested when, I mean, they were making the proposal. So this is essentially, I mean, what the investment bank proposed at the time of acquisition. So if you look at their own presentations, what they say is, I mean, we are giving 8.9 of EV to EBITDA multiple. This is, I mean, 10 to 25% premium. But essentially, I mean, they are talking about, I mean, a lot of reasons why this investment makes sense. So this is, I mean, what they shared with the investors. And so 2 points that you would notice here is, the first point that you would like to notice is, as a target, you need a company that is a cash cow. You also think that, I mean, the cash flows are not very sensitive, so that you can use high leverage. So these are some of the primary characteristics of a target for a leverage buyout. So that means you are not going to buy a company that is in the growth stage. You are not going to buy a company that is probably with a lot of cyclicality, or I mean, a lot of uncertainty with respect to revenue. So these are some of the key points that you notice. Again, a similar type of structure. You can see the sources and uses of funds. So you can see that, I mean, the total leverage is, again, the senior secured debt, the total senior secured debt. So you can see, and what is the type of interest that they are paying. So leverage plus 350 basis point, and the tenor of the debt, the details are given. So senior debt carry almost similar interest rate. And you can also see some amount of junior debt. The junior debt carries a high interest rate on average. And where is the equity coming from? Typically, you will see that, I mean, consortium consists of multiple private equity partners, and investment banks are involved in the deal. So you can see KKR there, TPG, Goldman Sachs, and Lehman, and I mean, Citi, a lot of, I mean, investors mostly contributing. I mean, the first 2 partners are contributing equally, or the equity sponsors are contributing equally. So you have around, I mean, the total transaction is going to be around 45 billion. So you can see this. This is, I mean, the source, but I mean, essentially, this is an example of another deal that failed. So having gone through 2 simple examples of, or I mean, probably 2 examples where the private equity firms failed when they, or I mean, in this kind of transactions, let's look at a third one. So in this example, Blackstone acquired Celanese. Celanese is a chemical company. It is a German company, but please understand, half of their revenue was coming from United States at that point in time. So how much they paid for this acquisition? They paid for this acquisition 650 million. So that is the total consideration they paid. And interestingly, within 9 months, what they did in 9 months, they did some kind of restructuring. Within 9 months, they listed the same firm in United States for about 3.1 billion. So you can calculate the return. It's more than 3 times. I mean, so essentially, you can just see that they reaped a cash flow windfall of 1.4 million, and you can just see, I mean, other kind of details, how much they got. And essentially, so there are many deals essentially returning 3 times the invested capital, 4 times the invested capital, 2 times the invested capital in LBOs. But at the same time, you see, probably, I mean, 1 out of 10 deals fail, and private equity firms may lose their investment. So, but as you can see here, just like, I mean, investing in startup firms, you make substantial returns from, unlike, I mean, if you look at, I mean, a venture capital firm, if your success rate is 10 to 20, or I mean 10 to 15, 10 to 30%, here what you are seeing is probably 90% of the cases you make good return and some of the deals fail. So this is the background. So probably, I mean, we will go to, I mean, the discussion or the detailed material right now. So any questions on this, this 3 deals that we discussed as examples? So the first one, we looked at the Toys R Us, a toy company. The second one is the Texas Energy utility company. Again, a failed deal with high leverage. The third one is Blackstone's acquisition of Celanese, a German chemical company. They acquired, made some marginal changes or improvements, and then got listed in United States, and probably got 3 times what they invested in this process over a period of just 9 months. Please remember, I mean, investing a few thousands and getting 3 times return is something not very difficult. But investing around $1 billion and getting, you know, 3 times over a period of 9 months is something that is extremely difficult. All right.
That means in the first 2 instances, the valuer went somewhere wrong, you know, in his analysis. That to that extent, value shouldn't have been there for the.
Shilpa, I mean, I would like to suggest, I mean, a different way of looking at it, or probably one is, of course, the valuation is not correct. I mean, you can always argue that. The second thing is probably, I mean, so when you go for a leveraged buyout or an acquisition in an industry, you made some forecast about, I mean, the potential, you know, upside in terms of demand. Look at what is happening to the toys market at that point in time. We have seen that, you know, from the offline to online retail, I would like to call it, and to video games. And essentially, I mean, the growth rate in terms of the population growth rate is going down. So you have made some mistake in forecasting the growth rate there. And the second point is, see, one area where you generate value through acquisition is sometimes what we typically call as the value of control. So essentially, what is value of control? Value of control is essentially, one is, I mean, you talk about the private benefits of control, but I mean, let us assume that there are no governance issues. If there are no governance issues, value of control comes from 2 sources. One is how badly the firm is managed right now. If the firm is mismanaged right now, there is more value of control, and how easily you can make a change. So to put it differently, when you look at a target that is already well managed and you are paying a huge premium of 60 to 70%, that's what happened in case of Toys R Us. You paid 70% premium, then probably, I mean, to extract more value from the same is going to be extremely, what do you mean? The probability is low. So whenever you go for a corporate control transaction, you pay something for value of control under 2 circumstances. The first case here is, I mean, essentially, I mean, let me put it in simple terms, whether the firm is currently mismanaged or it is managed suboptimally. What is the reason? If it is managed suboptimally, then you can bring the changes and unlock value. The second point is how easily you can carry out or bring these changes. So for example, if say, look at, I mean, many of the mergers, bank mergers in India, or the public sector bank mergers in India. one of the key idea or key, what you can say, learning from financial services mergers from, across the world is that you unlock value by way of cost reduction, because revenue enhancement is not, or revenue growth is not an easy strategy when it comes to many mergers and acquisitions. So cost reduction comes mainly by way of job cut, because when you merge together two banks, either you can reduce number of branches, because now most of the banking companies are nothing but a technology backend and a customer service front end, nothing more than that. That's the truth. So you need people from hospitality industry to manage banks, not someone with a hardcore finance background. Essentially, so that's the case that we see. So now, but look at the scenario in India. We talk about bank mergers, and at the same news we will read. We can read. There won't be any job cut. So essentially, merger is not going to unlock value because the cost reduction is not there in this kind of deals. So I'm going back to the example. So if a firm is already well managed, if you look at Toys R Us case, they have seen this problem. They were doing strategic restructuring already. So that means there was something happening internally into the firm. And now come back to the case of Celanese. So Celanese, what happened is, Blackstone partners were quite smart. In fact, one Indian who was the head of this deal, I watched his video also. So what they noticed is chemical companies are trading at, let us assume, a multiple of something like 8 times in Germany, in European market. What he noticed is the same chemical companies are trading at something like 12 to 14 times. I forgot which multiple he was talking about, almost 2 times in US market. He did a little bit of analysis and he found, yes, this is true. There may be reasons. You may think, why is it so? But valuation ratios sometimes see this kind of differences across the globe. So essentially what they did is they bought a company, that is Celanese, with 50% market in, revenue coming from Europe, 50% revenue coming from United States. Delisted in Europe and listed in United States. So essentially, they got the same firm listed in, if I'm right, in NYC. So in a period of 9 months. So this essentially, the change in valuation multiple is another thing that will bring better value. But look at this, essentially, when you imagine an improvement in valuation multiple, that will again come from the expected improvement in growth rate, or due to a difference in the geography in which you are buying or selling these assets, due to various other reasons. So these were not present in the first 2 cases. So there was no growth in demand, there was no cost reduction, a better valuation ratio was not applicable. Moreover, in fact, many of these factors were acting in the opposite direction. So that's going to be double whammy. Okay. So probably, now we may take about 10 to 15 minutes or 20 minutes trying to understand the private equity and how they are probably becoming a significant players in the global financial markets. In fact, around 10 years back, or 12 years back, economists carried an article, but the title of the article is very, very interesting: New Kings of Capital. Listen. So I think going forward, if you look at what is happening in the global economy, private equity firms are really becoming the rulers of financial markets. That's what we are observing. Probably they are the kings. So if you look at, many firms nowadays, they are not going to the public market at all. Take the case of even startup firms. Their valuations are above 1 billion, as we call unicorns. Many of them are not going to the public market because money is available, or there is enough capital is available in the private equity market. So let's look at what is happening. So this is the data source is from World Bank and Perkin. This is a report from Perkin Capital. So essentially, so if you look at the global private equity net asset value and public equity market capital, both are indexed to 1. So you can see here. So this is in 2000. Around 2020, this has gone to something like 2.8 times or something like that. But on the other hand, if you look at the private equity has gone up more than 8 times. So that means this is the phenomenal growth happening. A lot of money is going to the private equity. It may be investment from high net worth individuals. It may be investment from institutions. But what you observe is that a lot of money is going into the financial market. So Chirag, it is barbarians at the gate. Barbarians at the gate. Essentially here, please look at this. So the global private equity market multiplied 8 times. And also, please look at this at the same time, the public equity market has just doubled, or it has gone 2.8 times. But please remember, I'm not making a comparison. Even at this level, the private equity market may be 1/10 of the public equity market, the total size. I'm just showing the growth rate. It has gone at such phenomenal, even at this point, because this is indexed to 1. So please understand, this is probably at that point in time, 1 by, so 5% of the public equity market. Now it is maybe something like 10 to 12% of the public equity market. So where is the money going into? The private equity market. In fact, many of you may be thinking most of this money is going into startup or venture capital. So that's not the answer. You can see here, roughly about $1 trillion is what is going to the VC. So that means almost 2 times the investment is going into the LBOs or into the buyout firms. Now, of course, as you can see here, unlike, the relative proportion of investment that is going to the Asian market, 42% of the VC money is going to the Asian market. So you can see here. On the other hand, only 11% of the money is going to the buyout market in Asia out of the total share. So if you take 11% of the same, 11% of the same is going to be significantly 11% of 2 trillion. On the other hand, this is, 42% of 1 trillion. So that's, you can see the difference. So still, VC money going to the Asian market is substantially more than the LBO money going into, or the buyout money going into the Asian market. But at the same time, probably things may improve. Many of the countries in the Asian market is changing their regulation, becoming more friendly to, 100% stake acquisition, and the debt market is also improving. That may lead to more activities here. So now, we got this request to briefly go through LBOs. Of course, that was originally there in the discussion. So let's go through this discussion. So LBO is typically an acquisition strategy where an investor group buy equity. So essentially, you can see the first case, go to the investor group, you have KKR, you have Bain Capital, you have, real estate investment fund. So put together, these two firms are buying. So this is essentially what we call is the sponsor group or the private equity partnership. Typically, you use 50 to 80% debt while acquiring the company. See, for example, when Nirma was acquiring the Indian assets of Lafarge, they used around 4,000 crore borrowed money. And the leverage nature of the acquisition is essentially forces the management to operate at maximum efficiency. Otherwise, you will be in financial difficulty. So this brings some kind of discipline in the management. And of course, as you know, leverage brings attractive return. As you know, all of us know, leverage is a double-edged sword. If you are earning a rate of return better than the cost of borrowing, leverage will give you better return as equity investor. If you are generating a rate of return lower than the interest expenses, leverage will probably bring down the shareholders' return. And so that's what you see. Targets are normally in mature industry. Look at the three examples that we discussed. One is a chemical company. Typically, I mean, basic chemicals, you may not really face much problems. I mean, it's a mature company. Energy utility, and probably, I mean, a 2-year retailer. So they have low requirement of capex. Presently, they have low leverage. And sometimes, see, for example, Toys R Us, they have a lot of real estate property that can be sold. And when you borrow more money, that will lead to tax deduction. And essentially, this tax advantage of debt also creates some value. So these are the key points. How will you really look at? So probably, I mean, please remember, if you want to attract or get a good return on your investment, what you plan to do is bring down the leverage during a reasonable period, say typically 5 to 7 years. I mean, as we have seen in case of Blackstone's acquisition of Celanese, it was just 9 months. So you pay off the debt or substantial portion of the debt, and then again take it to the public. Typically, we call it SIPO, I mean, a secondary initial public offering. So a firm that has already completed public offering, you take it to private. This is what we call is going private transaction. And then you probably go for a restructuring or turnaround, and then again you take it to the public market. So sometimes you may follow a simple bust-up strategy. Essentially, you sell assets separately and then increase efficiency. Sometimes what essentially you do, you acquire a company and use it as a platform, purchase another one, build a big entity, and then sell it. So you can have a build-up strategy. So both are being followed. Another key feature here is the financial buyers or sponsors. As we discussed in the first deal, you have KKR, you have essentially Bain Capital and so on. In some other cases, I mean, you may have also investors from investment banking, not really, I mean, specialized in this, I mean, right. Okay. So let me just ask one question. So how is a hostile takeover different from LBO? Okay. So let me just answer that question and then I will come back to this. So if you look at acquisitions, acquisitions are one way of classifying acquisition is hostile versus friendly. So please, a hostile acquisition versus a friendly acquisition. Another way of classifying the acquisition is, I mean, as we discussed, LBO or MBO, managed buyout or leveraged buyout, and I mean, probably, I mean, a normal one. Can LBO be hostile or can LBO be friendly? Majority of the LBOs are friendly because most of the time you retain the target management also. In fact, majority of the time, the target management also make investment. Sometimes it is also known as MBO because the management is buying the organization from the public shareholders. So LBOs are not really hostile. Now, on average, now this leads to an interesting question. What do you mean by a hostile acquisition? A hostile acquisition is one where the bidder is directly negotiating with the target shareholders, not with the management. This leads to an interesting, again, another question. So you won't see a clear separation of ownership and management in India. In fact, in India, only 8% of the companies, this is, I mean, as per analysis, only 8% of the companies would have this feature of clear separation of ownership and management. So that means for about 90% of the companies, you can identify a single owner. Okay. So, but essentially in a hostile acquisition, what happens is rather than negotiating with the target management, you directly make an offer to the target shareholders. And the target management may not be comfortable with this deal. They may try to probably block it. Essentially, this is what we call is the various type of takeover defenses that they employ. Also, please remember the target management also bring a friendly acquirer, sometimes what we call is a white knight. So this is, or a white square. So this is what happens. Harsh question is huge difference in Asia and venture capital and private equity. So Harsh, most of the time, the venture capital firms invest money in startup. So that means if you have more of startup, or essentially a network of startup firms, that is where the venture capitals are going to be more active. On the other hand, I won't use the term buyout. Buyout is more applicable for mature funds, and typically LBO as a term is used when you acquire a publicly listed firm. Normally, not always, but in general, you buy a publicly listed firm using lot of debt. I hope that term is clear. And also, please remember, in United States, private equity is a broad term. This consists of firms making VC investment also in United States. Europe, the term is used in a slightly different context. And so private equity is a broad term where VC is a subset of private equity. So any other question?
I have got a question.
Yes.
Can I?
Yes, Raj.
Okay. In case of insolvent companies being acquired by the resolution applicants,
Right.
If at all that target company is acquired through debt, I'm coming to the specific point of a case of Ruchi Soya, which was acquired by Patanjali Ramdev, and it was through Swiss Challenge, which was done by Adani, taken over by Adani. Then he backed out. Ultimately, it went to Ramdev, Patanjali, and he bought it through debt taken from the PSUs. So you will essentially cover it under point 1, under this leverage buyout, or the ordinary one, and 2, hostile takeover or friendly takeover, friendly acquisition. So hostile acquisition or friendly acquisition.
See, two points I would like to make here is, one is, most of this case, when someone is referred to IBZ, the target management may not have much all there. So
yes,
so that means, first of all deals happening through IBZ, you can categorize. It won't really. It's a totally different question. So the shareholders have no option. Point number 1.
Right.
The second thing is, can I really bring it under LBO? It is probably, it's a good question, but what you observe here is they are also using most of this debt. In case of Ruchi Soya. So technically speaking, when you use lot of debt, or typically more than 50% debt to acquire a target company, that will come under LBO. In that way, you can call it leverage
LBO. Exactly.
So IBC, there is no question of hostile or friendly, so we can just remove that part of the discussion. But please remember, legally still there are problems, because banks are not financing. Banks are not financing, because we are a bank-based system, so banks are not financing. So they may have obtained this debt from other type of institutions. Point number 1. We may have to look into the details further.
But it was acquired through banks. The debt was taken from the banks.
Probably, there may be some other assets they may have given. See, there is a difference. When we use LBOs, you finance, say, for example, many of the Indian companies going abroad and taking over other companies using LBO route. I won't like to call it as a typical LBO, because what happens is they give the security of the parent's assets here.
Exactly.
So it is not the target assets which is under risk. The parent is saying, okay, in the event of default, you can, we will make sure that, you will get paid. That is why you see, essentially, most of the Indian companies acquisition, whether it is Tata's acquisition of Tedley or UB's acquisition of White and Mackey, always you give a guarantee, the parent company is giving a guarantee.
Right.
Whereas in case of most of these private equity firms form a special purpose entity, invest equity, and that's it. That entity borrows using its own asset. So there is a subtle difference that you see here. And even right now, Indian firms are not able to probably replicate this typical LBO transactions.
Correct.
Can I?
Yes, Ragesh. Yes, sir.
LBO, what you are told that hostile and friendly, both one way or other is attached with management or the shareholder of the company. But in this case, it was not that shareholders as well as management has got nothing. Now in LBO, one more point you have told that it will be on a specific asset of the company itself, not of the other company.
In general, yes.
General.
Yes.
So in a US market, when the LBO transaction happens, they will look for the asset of that company only or the others also.
No, exactly. I mean, so essentially, I mean, only that assets based on the strength of the assets only you borrow.
Okay.
That is,
Thank
I mean, that is why, I mean, probably we may list down, 10 or 15 of Indian LBOs, but typically what is happening is the parent company is giving a guarantee.
Guarantee. So that is not a typical LBO transactions, we can
That
say.
is not a typical LBO transaction. So because, I mean, in a typical LBO transaction, also, please remember, most of the case, these kind of LBOs are not done by, again, the buyouts you classify between a strategic buy and a financial buy. Okay, so a strategic buy versus a financial buy. So in a financial buy, essentially you look at, I mean, the type of firms active in this, KKR, TPG, or Bain Capital. These are the firms not operating in any particular industry. But when Tata Global Beverages is going and buying Tetley, is it a financial buy really? No, it's a strategic buy. Many of the Indian companies say UB is going and buying White and Mackey. Is it a strategic buy? I mean, is it a financial buy? No. What do you mean by a financial buy? Essentially, you are doing an IRR or NPV analysis and saying, okay, this is the reason why I'm going for acquiring this company.
Okay.
But
So
look at the Indian companies using the leverage route sometimes to acquire foreign companies. What is the reason? Look at, I mean, Tata's acquisition of Jaguar and Land Rover. It's probably, I mean, fully driven by strategy. So though they were using debt, I mean, that is not essentially, I mean, just they are considering it as a positive NPV projects.
So it means a strategic,
yes.
In a strategic buyout and financial buyout or whatever, the strategy will be totally different.
Yes, I agree. So probably, I mean, there is an excellent article by, again, because I mean, you are all interested in, reading Nirmalya Kumar. This appeared in HBS, Harvard Business Review, HBR, how emerging market giants are rewriting the rules of acquisition. How emerging market giants are rewriting the rules of acquisition. So that has something to do with the mandate. So, I mean, we will stick to our point. I mean, otherwise we may find it difficult to discuss. I mean,
I have a question here.
Yes, Harshil, there is some echo. Yeah, please continue.
So in venture capital and in private equity, there is a difference in the market share if you compare to India and you compare to US market.
Right.
So what is the logic behind that particular
thing? So I mean, interesting and good question. So I said mostly in Europe and India, you can see that. Okay, I'll come back to your question. So essentially, look at, I mean, the activities of venture capital firms. Venture capital firms are quite active, probably US, China, and India. One of the reason is the probably this number of startup and innovative ideas from these different economies. Of course, Europe, when it comes to life sciences, startup, and so on, I agree. On the other hand, the buyout activity is quite common in United States. What is the reason? There are multiple reasons for this. starting from the philosophy of a corporate entity, US is different from the rest of the world. So in US, you run an organization primarily for shareholders' wealth maximization. Therefore, the moment the company is deviating from this objective, the institutional investors will become active. They will try to probably unlock more value. There will be change in management. There will be change in control. On the other hand, in India, I'm just coming back to the point. In India, you have the system where let me just first go to the European market. European market is more used to the stakeholder capitalism. So that means it is not easy to buy a company in Europe unless you get approval from multiple stakeholders, including employees. India is probably more closer to US, but in India, the major problem is concentrated ownership. In the presence of concentrated ownership, it is not easy to acquire a company without the approval of the dominant shareholder. The dominant shareholder himself is going to be, in most of the cases, the top manager also. So that is the key differences that you observe. Apart from that, you will also see regulations. So India and many other Asian countries permit investment by foreign entities into startup. And another point is, VC is not really worried about whether he is getting 10% ownership or 20% ownership. Because, the controlling stake is not important. Unless you have a really bad manager in controlling a startup firm. So, I'm just coming back to the point. So, who is running a company is, but on the other hand, most of the value creation in case of an established company comes from the value of control or replacing the existing managers if they are inefficient, or probably going for some asset sale and improving margins through the management. So you should have controlling stake. So that means, let me just summarize the point. It is not easy to make a complete change in control in Asian countries or in European countries, point number one, because of the regulation. But on the other hand, when it comes to the venture capital, complete control is not required. And the second point is there is concentrated ownership. Concentrated ownership brings its own benefits and problems. The third one is restriction. In terms of, another point is you need to finance it. So there is, what you observe is there is a junk bond market, and or the ability of this kind of firms to borrow money in order to make investment is also another issue. Okay. So I'm just giving you a typical LBO structure. This typical LBO structure is taken from a textbook, but just to give you an overview, a typical LBO structure is where you have, equity and probably, debt that is coming, and how it is being shared, the ownership structure. You will give sunset equity to the existing management. You will also give some capital to the former owner if there is an owner. And the remaining ownership lies with the management. Typically 20 to 50% equity and 50 to 80% debt. So this is the structure that you see in an LBO firm. So you bring 20% equity, borrow 80% using debt, and have 87% equity ownership at max. And remaining is shared among various other constituents.
Can I ask you a couple of questions, sir?
Yes.
So now, as far as the private equity is concerned, when they bring in the money to take over, what would be their exit time frame? That would be about 3 to 8 years, typically 5 years, 8 years.
Typically 3 to 7, 3 to 8 years.
Right, and in the case of debt, also the debt time frame for
debt is typically, divided into different heads. One may be a bridge capital, which they promise to repay quite fast, probably in 2 to 3 years through some asset sales. So essentially what you do is you just say that, we are going to sell so real estate or other properties or a subsidiary. So they will say that this will be for 2 to 3 years, within a short period of time. And then they will try to pay most of the time, interestingly, you will see that, I mean, the debt is divided into junior and senior. And depending upon the agreement, you may repay the debt. So typically what they do is, except the secured senior debt, the junior debt is completely paid off before taking the firm to the public. So that means the maturity of the debt is typically in the range of 4 to 6 or 4 to 8 years.
Okay. So is it possible that the private equity player, whoever is doing the LBO, comes in both with debt as well as the equity?
Oh, in many cases, yes. Right. So, I mean, I got your question. The private equity player may bring equity and also may bring the subordinated junior debt. In most of the deals, in fact, they do that, and that will be carrying a very high interest. In some regulatory environment, the tax authorities say, no, this is not permitted because such high interest rate is not permitted. I hope I made it clear. See, for example, absolutely. Look at the structure. You may contribute 10% debt, 10% equity, borrow another 50% or 60% from outsiders, put together 70, another 30%, you again contribute as debt. So if this may carry about, I mean, let's assume 10% interest, this may carry 20% interest. But regulators may say, no, this is not. This is, I mean, equity in another form. But
so it is double leveraging then.
This is what they pay off. And so that, I mean, you will see that they will deleverage and then take it to public. That is why, even if you go back to the example of TXU or something, you will see that the private equity players may not have lost so much money, because by investing in junior, what you can say, unsecured debt, they may have paid some good return for that part of the capital. But still, they lost money, because, I mean, unless you are able to take it to the public or find another buyer, you will lose money.
So in this case, this 30%, which you say is in the form of debt, it's at times some PEs are also structuring it in the form of convertible debentures. So initially convertible debentures or something like that, so that initially it gives them interest, and later on they have the control also, so that in case something goes wrong, they can have the control also on this. So is it the same part or something different from that?
I'm not sure the example, but generally what is happening with the Indian companies, they bring most of this debt in the form of NCDs only. They non-convertible debentures.
Even this 30% also?
Yeah, 30% also. They
which part of this they bring it in the form of convertible debentures? Out of these three, if you take the example?
Convertible shares, I mean, preference shares or convertible debt is more common when you look at a startup financing.
True.
When you look at a startup financing, that is common.
But otherwise also in acquisition financing also it is happening.
I am not able to completely recollect some examples. I need to look at that. Probably, okay. I mean, you can email.
Okay.
I will check and get back to you, because
please.
I mean, it is possible. I'm not saying it is not possible, but in general, even you look at, I mean, Indian companies or foreign firms, floating entity abroad, borrowing money and bringing it to India. They bring it, I mean, as equity investment and NCDs. They invest in
so that. Why I'm saying so, that is how they retain the control of the company in case of a default. I mean, in case of default. So that sooner or later, be it even banks also, they do it in this way only when they do the financings.
Okay. You are saying when the banks, if they are asked to give this junior subordinated debt, they say give us, I mean, either FCD or PCD. That's what you are saying. Okay.
Precisely, yes.
Okay. I need to look into that, because I mean, I don't have any specific right now.
Fine. Thank you.
I have a question. So you were talking about secured debts, which is used to finance this deal. So this security is given. I mean, what is the security, underlying security? Is it the target company's assets?
Yeah. Look at the examples. The three examples would illustrate that. So the first case is what we discussed is the toy retailer, and they own a lot of retail space, real estate. The second case is a Texas energy utility. So essentially, most of the energy utilities have a lot of fixed assets. And the third example is a chemical company with physical assets. So essentially, I mean, it's the physical assets that is providing the security. Okay. So probably I think I will just quickly go through some ideas, then we will have a break. Just shall we have the break right now, or shall I take 10 minutes more? 10 minutes? Okay.
5 minutes more.
Yeah, so we will go up to 9:15 and then we'll have a break for 5 minutes. Okay.
Okay.
So essentially, I mean, one of the key numbers that you look at in LBO analysis is IRR, which I will discuss with the spreadsheet example, because I mean, I won't spend much time here. So essentially, first you need to calculate the cash flows, just like, I mean, most of you are quite comfortable with the cash flow calculation and so on. Please again, remember a standard LBO model. Typically we do many case studies. We have more templates. I have just shared with you a simple case to illustrate it. That's not a detailed template. You have many detailed templates available. I mean, but that we are not using. It's not possible to do that in such a short time. And typically you calculate the cash flows available to debt service. It is exactly same as what we discussed. So essentially, look at this. This is, I mean, the total free cash flow only. There is nothing, different from that. This is, I mean, the total cash flow available. The only, I mean, point that you notice here is you need to deduct, I mean, the interest also, the after-tax interest. So this is, I mean, nothing but the free cash flow after the interest payment is what we call is cash flow available for debt service. So exactly same as free cash flow. The only difference between free cash flow and cash flow available for debt service is, I mean, assuming that most of the LBO analysis, we assume zero dividend and zero payment to the equity shareholders. So as you know, free cash flow is the cash flow available for both equity holders and debt holders. Assuming that you haven't paid anything to the equity holders, then free cash flow can be explained as cash flow available to service debt, that is interest payment and debt service. So that means free cash flow minus after tax interest payment, that will give you the cash flow available for debt service. I hope it's clear. Do you need more discussion on this? Okay. So probably what we will do is, I mean, most of these factors we have discussed. So we will have a break. We will meet at 9:15. 9:15, you will have some, what you can say, poll. So 9:15 or 9:20. Let's make it 9:20 because, I mean, if some of them join 1 or 2 minutes late, then they may miss it. So we will start at 9:15 and then we will have the poll at 9:20. Then after a brief discussion, we will go to Excel. I can see some questions there. Okay. Okay, we'll have a break for 5 minutes. Okay, welcome back. So,
Professor.
Before we start, I'll just make a small announcement.
Yeah.
Yeah. Good morning once again, everyone. I want to talk on behalf of Bangalore Valuer Association. I would like to invite all of you to be a part of our association. It's an appeal. As you all know, we have been conducting this program for over 1 year. Every second Saturdays and fourth Saturdays in the early morning hours between 8 to 10, so that it will not disturb our regular working hours. And also the fees for this is very nominal. We have kept for all the registered valuers who are registered with IBBI at 3,000 rupees, and for other passionate valuers who are passionate about this profession at 4,000 rupees. And if you are willing to register within this month, we have got a discount of 10%. So it will be 2,700 rupees and 3,600 rupees. And I also want to thank Aqua, the Association of Certified Valuers and Evaluators and Analysts, for helping us to get the CPRs. So almost around 24 to 30 CPRs will be conducted during the year, and we will not have to worry about accumulating our CPRs also. So that is again one of the beauties of being a part of our Bangalore Valuers Association. I would also request Sir Abram sir, if you want to tell something about our association so that people can get connected to this program. And I see a lot of people, coming to this particular program today. I think more than 15 to 20 non-members are there. So I request them to be a part of our association. And also the members of our association, I request you to volunteer for various roles. Next term is starting, so we request you to volunteer for supporting us. You can either personally message me, Shilpa, or Abram sir on this matter. Abram sir, for you, or a couple of minutes.
Thanks, Ravi. And Professor, let me just take a couple of minutes, your permission. Okay. So I think that we have tried to make our topics interesting to valuers, and we have tried to add value to them by giving them the ability to carry out valuations in areas where they have just a little bit of experience. We are trying to equip them with the capability to do valuations on their own, courtesy these sessions. So as a part of the ongoing effort, we would like those who are capable to come up and speak on some of the new topics which the IBBI has brought out for us. Like, for instance, there is, we can talk about 301, which is the valuation standard which has been brought out by the ICAI. Or there are other topics which are in relation to material which has been published by ICAI or the IBBI. So we'd welcome those who want to take these on as topics and broadcast them to the other members who will gain from your knowledge and expertise. I know that Mr. Adar Sharma, for instance, who is an experienced valuer, has told us that he will carry out a session for us in due course, and we look forward to sessions from him, for instance. So just like that, we will request those who are capable, like for instance, Subhajit, I think that you can definitely carry out sessions for us on valuation topics. And we look forward to each of you participating and sharing your expertise with the others. That's all from my side. Over to you again, sir.
Okay, thank you. So I hope, essentially what we do in an LBO valuation is, first you find out, the price that you are paying, then you find out the cash flow available for debt service during this period, that is taking the firm to private, to, the sale, say after 5 years or 7 years, you will be using this entire cash flow to service debt. So this is, the typical LBO valuation models. And then you look at, what is going to be the remaining debt and equity at the end of this period. We will work out a simple example as we do. So typically you have the total debt to equity ratio. This is, not always going to be the same. Please look at this. This is the number from here, but it can be, as we have seen already, it can be as high as 7 times sometimes. So as we have seen, this is the typical range suggested, but this typical range is, from something like 2007. So you have the senior debt, you have the EBITDA to interest coverage, at least, should be greater than 2. And so these are some of the numbers that you look at, in order to see whether, numbers are going fine or not. And so I'm not spending much time. So because we have only limited time, I would like to take you through the spreadsheet also. Otherwise you may find it not really helpful. I mean, so while going through the spreadsheet, I will explain some of these terms. One of the numbers that you look at in LBO analysis is just IRR. Just like, I mean, many of you are familiar with the VZ method of valuation. In the VZ method of valuation, you use IRR to find out the required stake, or I mean the required rate of return to find out the stake. Here, you back out the IRR and compare it with your required rate of return. Why we are going for NPV, or I mean the typical cash flow discounting? Because it's difficult to find out the required rate of return. That is one of the reasons why you are not doing it. Okay. And so probably, I mean, I will just take, I mean, what is the objective of LBO? See, please look at this. You have 20% or what you can say 30% or 35%. So 35% equity, 65% debt. Now what we are saying is at the end of the period, you will have 70% equity and something like, I mean, 30% or 40% debt. So this is what you are planning for. And how you acquire this, how you reach to this stage, I mean, over a period of, let's assume 7 to 8 years. And what you say is, you probably buy it at 7 times LTM and sell it at 8 times the LTM. So the IRR, we will discuss. Another number quite frequently we will go through is what is known as MOIC, as a multiple of invested capital. This is a number that we use. Please remember, multiple of invested capital is quite frequently used by private equity funds. You can improve multiple of capital by keeping your investment for long period. As you know, say the IRR may be lower, but the multiple of investment may be higher. If you keep the same investment for more period, you will see that even with a lower IRR, you will get a better MOIC, multiple of invested capital. So this is, I mean, another point. So two numbers that is quite frequently used by PE firms, one, I mean, or LBO firms, buyout firms, is IRR and multiple of invested capital. Please remember, multiple of invested capital is not a really good measure because you can attain or achieve a better MOIC by keeping the investment for long term, even though the rate of return is lower. See, for example, in this example, your IRR is 30%, but the investment is active only for 2 years. The multiple of invested capital is 1.69. As again, as a 20% return over 6 years will give you 2.99 times the multiple of invested capital. So this is, I mean, essentially the return during the period 2000 to 2019. Essentially, the investment is happening from 2000 to 2016. You will see that the top 5% of the firms are earning much better return. You can see that, I mean, the small cap buyout firms are in the top 5% of the firms are making an IRR of 40%. Same is the case. The bottom 5% of the firms are not making so good return. It's actually minus 10%. And where is the median? The median is somewhere around 15 to 20%. So on average, private equity firms earn better return compared to the public equity market. So on average. But essentially what you see here is one of the interesting points that you see here is normally small cap buyout firms are doing much better compared to the large cap buyout firms. So that is, I mean, something which you would be able to appreciate here. And also there is more diversity, or probably there is more, what you can say, standard deviation in the performance of small cap buyout firms. When it comes to the large cap buyout firms, essentially there is less of volatility, but I mean, the returns are more concentrated. You can see that the median return is again around the range of 14 to 15%. I will just look at, I mean, some of these numbers. Skip. Where is this return coming from? That's the first question. See, I mean, let's assume that you are investing 1 rupee to start with. You are investing 1 rupee to start with. And at the end of the period, let's assume you got 2.2 rupees. So that means as a multiple of invested capital, you have 2.2. So multiple of invested capital is 2.2. So you invested 1 rupee, you got 2.2 rupees. So essentially, the analysis I mean, from the previous table, the same, I mean, they have looked at. So what are the factors contributing to this? One is the revenue growth. So the company, after taking over the target, they were able to improve the revenue. The second one is the margin expansion. The margin expansion essentially indicates that, I mean, they are able to reduce the cost. And the third one is the multiple expansion. You were able to get a better valuation when you exit compared to what you invested. So three most common factors contributing to the return is revenue growth, margin expansion, and multiple expansion. So these are the reasons for, I mean, the better return. So probably we may take about 5 minutes. You can have the I mean, poll, and after the poll, we will start with continue with the rest of the session.
Sir, what is the multiple? What is the multiple?
One second. Just a moment. I'm not able to go back. I think the screen is locked for a moment. 1 second. Yeah. Tell me, what is your question, Ragesh?
What is the multiple expansion over here?
So essentially, I mean, please look at this. This is the enterprise value at starting. This is the enterprise value at the end. I hope that is clear. So you bought something for 1 rupee, you were able to sell it for 2 rupees.
Yes.
Okay. Now, where is this coming from? That is the question. Okay. Let us assume that you bought something for, I'm just making some numbers to explain it. Okay. So you bought something for, let's assume, to make it easy, 100 rupees, and this is 200 rupees. 220 rupees. Okay. So this is 100 rupees is the price at which you bought. You sold it at for 220 rupees. Ragesh, this is clear?
Yes.
Okay. Now, what are these numbers essentially giving you?
So revenue growth and margin expansion, I understood. The third one.
I'll come to your question. 1 second. So let us assume that, I mean, when you purchased it, your EBITDA was, let us assume, 20 rupees. 20 rupees into 5, that is equal to 100 rupees. Are you with me? Is it clear?
Yes.
When you are selling this, I'm just taking an example. I mean, here, so you are, let's assume that you have 35 rupees of EBITDA, 35 rupees of EBITDA multiplied by how many times? Could you just do a quick calculation? 35, 220 divided by 35?
6.28.
6.28 times. That is equal to 220. Now, Ragesh, please look at this.
Yes.
You use the multiple of 5 when you are buying it. When you are selling it, you have used the multiple of 6.28. That is what is the multiple expansion.
Okay.
Okay.
Got it.
And from 20, this has moved to 35. This may be coming from 2 sources. One is the revenue growth. Another one is the cost reduction. So this 35 is explained by way of margin expansion and revenue growth.
Yes.
Okay. So let's have a 5 minutes for conducting your poll, and then we will continue with the rest of the topics.
Hope everyone can see the first poll question.
Yes.
I request all the participants to participate in the poll, as the report will be sent to IBBI, and the attending of poll questions is mandatory for all the participants.
Shilpa Subbarao here. For a minute, remove me as a co-host. I can't give the answer.
Probably, Shilpa, could you keep some 2 questions towards the end of the session? So you can conduct 3 now and 2 you can keep towards the end.
The poll is about to end.
Shilpa, still I am co-host. Can you remove my name?
Ravindra is the host. I'm not able to.
Okay. It's okay.
I'm ending the poll now. Are the poll results attendees can see?
Yes, Shilpa.
Yes, you can see.
Professor, would you like to share the answer now or shall I move on to the second poll question?
You may share the answer. The answer should be B and C. So that is the choice D.
Yes, yes. Second poll question is launched.
So please note, I mean, it is not considered as a characteristics. Not. It's important. Not should be underlined.
So, Professor, while we are answering the poll, can I ask you a question? That is, can an LBO buyer bid higher than a normal strategic buyer?
Oh, that will be answered after this.
Okay, right.
The poll will be stopped now. As all of you can see the poll results, the third option is the right option. Professor, I'll be launching the third poll question also.
Oh, yes, fine.
Yeah, I'm stopping the poll. As all of you can see, the second option is the right option, going private transaction.
Okay. So we'll conduct the remaining poll towards the end. So let me answer this question from Abraham Matthews. So one of the key questions that you may face in valuation is, what is the connection between these values, that you see in different contexts? So while answering your question, probably I will also touch upon some other aspects, then I will come to this. See, we may value a firm using something known as cash flow discounting. And then you may use trading multiple. Then you have the transaction multiple. Typically, how these numbers looks like, the first question, then I will come to your question. Okay. So cash flow discounting typically will give you the floor in a general valuation framework, because what is happening is you may not be able to factor in growth outside the main business. As I look at a company like Reliance, if you are looking at Reliance 5 years back, you may not have considered revenue coming from telecom business or the growth. What about a trading multiple? Trading multiple to some extent factor in this value outside the core business, because the market is sensible enough. They may think that, okay, if the business is not able to do well in its existing line, it may diversify and get into something else. So typically the cash flow discounting will give you a conservative number if you are doing it correctly, and the trading multiple may give you something more. Now come to the last one. What about transaction multiple? Transaction multiple normally gives you a better number. To start with that, see, a deal is going to take place if and only if you pay a premium to the market price. Otherwise, no one is going to sell. So essentially, how much you pay? The maximum price that you can pay to a target is equal to the current market price of the target plus the synergy that you are going to create for a strategic buy. So the transaction multiple will give you value that you are paying is value of the target standalone plus the synergy that you are creating in a strategic buy. Now, what about a financial buy? For financial buy, we assume that synergy is going to be 0. If synergy is going to be 0, can financial buyers pay a premium over and above the strategic buyers? The answer may look like, no, it's not possible in general. I also agree with that logic. In general, synergy for a strategic buyer is close to 0. Therefore, they can't pay a premium over and above a strategic buyer. But at the same time, we may need to look at, some other unique skill set in the hands of financial buyers. The first point that you need to look at here is, if a financial buyer is more smart in unlocking the value of control. Value of control is essentially restructuring the business and essentially running it more optimally. Compared to a strategic buyer, most of the financial buyers are much smarter than strategic buyers when it comes to probably stripping the assets that are not doing well, probably restructuring the business and running it. Value number 1. So that means the value of control is going to be more in case of, you may call it value of restructuring. I'm using the term value of control. You may use something else. That may sometimes be more than synergy that you are proposing. Second one is the tax advantage. So the present value of the tax advantage that you bring essentially is going to be much more. Sometimes you may also think from a different point of view. If a typical US LBO firm, I'm just coming to the point, a typical US LBO firm is making the upside more in its pocket and downside is shared with the borrowers. Please look at that. Bankruptcy means the downside is going to the borrowers. And if that way they can systematically fool the lenders, I'm just going back to the point, That means there is some kind of wealth transfer from the borrowers to the equity investors. When that wealth transfer is present, I'm not saying always it is present, that means if the debt is not priced appropriately, you are using huge leverage and the investors or whoever is giving debt may not be priced appropriately, in that case, I mean, you are getting a value. Third point, so that means wealth transfer. And the last point I would like to bring it here, by maybe wrong. Look at, I mean, a financial buyer. A financial buyer is making more rational decision and may be able to obtain advantage of difference in cost of capital across the globe, which a strategic buyer is not able to probably, essentially do. I would use the term capital arbitrage. Capital arbitrage, both at the start of the game and at the end of the game. What does it mean? You are able to obtain money at a cheaper rate from a foreign country and invest in India. I'm just giving an example. That is what typically, and we call in hedge fund terms, a currency carry trade. You can give a part of that benefit to the shareholders. You can pay a premium. Another form of arbitrage that you may be able to do here is at the end of the period, just like what happened in case of Celanese, you may be able to find some investor whose cost of capital is lower. So bringing these factors, sometimes an LBO partnership may be able to bid at a higher rate, but these factors should be present. So a LBO partnership can bid at a price greater than a strategic buyer, provided the value of control is significant, provided the tax advantage of debt is going to be significant, provided the debt is not priced appropriately, there is wealth transfer from debt holders to equity holders, or a sort of capital arbitrage, either at the beginning of the deal or at the end of the deal is going to take place.
It's a great explanation, sir. Thank you for that.
I had some questions arising out of that.
Yeah.
Professor?
Yeah, yes, please, please.
So the LBO assumes that the buyer is independent to change the company, the target company as he wants, or at least substantially. In a very highly regulated environment like in India, where the unions have a say, the government has a say, everything can be stopped at the courts and so on. Do you think this LBO, advantage over a strategic buyer remains?
See, I mean, once you can get complete control over the company, I think both Indian firms as well as, a company in United States or in India are at almost the same, what you can say, level.
Oh, okay,
but the major problem that you see here is to get 100% ownership or to take it to the private is not something very easy.
Okay, so just to give an example, government wants to privatize Air India. Let's say there's some firm which does a leverage buyout. I would expect all sorts of problems to come in the way of that buyer, because right from no retrenchment to sale of...
I completely agree, Narendra. I mean, please remember the point that we said. Value of control comes from two sources. Value of control comes from, the first one is how inefficiently the firm is managed right now. The second one is how easily you can change the current practices.
Okay, got it. Okay.
So what you are saying comes to the second part. If you can't make any change in the, target company, value of control is zero. Because it is completely going to be inefficient. You can't bring changes.
Okay, one more small question. You spoke of tax advantage. Now the buyer is taking on debt. Normally, you will get a tax deduction on the interest and so on. Would that tax deduction be allowed in? I'm just have a doubt, because this is for purchase of capital assets. There is no income, coming that way. So if it is,
I agree. I'll come back to your question. See, for example, as I told you at the beginning of the discussion, it is structured in two different ways. One is you use a special purpose entity to acquire the equity of the company. That is one way of doing it. The other method of doing it is you just bring this debt to the target company's books of accounts. How is it possible? When you invest in the target company, you invest in equity as well as we discussed already, NCDs in India or by way of debt. So from your books, if you started or if there is a special purpose entity, then from the special purpose entities, it should be transferred to the books of accounts of the target.
But if the target company is not making profits, no,
that is not a target for LBO at all to start with. Look at this. What we said: companies in the mature industry with a lot of free cash flow, with profit, they are the target of LBOs. Other companies, a startup firm is not the target of LBO.
Yeah.
Okay. Bye. So I will just discuss. Typically, the financial sponsors determine the purchase price, and based on the multiple of the enterprise value, typically you may say it's 7 times, 8 times, as we have seen in the case of the Toys R Us, it's 7.9 times EBITDA. So this is the standard being practiced by the investment banks. And also what you observe is most of the time the financial sponsors forecast the future sale price typically at the same EV to EBITDA, or sometimes they may say that there is going to be a multiple expansion. If there is a multiple expansion, that need to be taken. And at the end of the holding period, they will either go for an IPO or they may go for an MA, mergers and acquisition. But essentially, you need a valuation at the end of the period. So this is how you arrive at the numbers. Interestingly, what you observe is that valuation plays an important role. This is based on the 2009 survey by CEPRS, essentially looking at the private equity firms. So what you can see is that, the EV multiple, enterprise value to EBITDA multiple, determine the type of return that we earn. So you can see that when the entry multiple is lower, 5 times to 8 times, you can see here the top 25 firms earn substantially higher return, almost like 30-35%. On the other hand, when the EV to enterprise value multiple is something like 12%, the type of IRR they earned is substantially different. So you can see here, this is the median, and this is the mean. So you can see here, when the entry multiple is lower, you earn better return. When the entry multiple is higher, you earn lower return. So on a simple analysis, what you observe is that the valuation at the time of entry is an important determinant of the return that you earn when you offload your investment. So we will look at these numbers. I think we have only 5-10 minutes. We were going a little slow. I will just take you through the spreadsheet, and then if there is some questions that we will address. Okay, so let us go to the spreadsheet. So please, I have already shared it with you. What I will do is I will quickly take you through the solution, and I will upload the solutions as well. So that is going to be easy. I won't be able to work on the spreadsheet now. So please look at the details given there. You are buying. Okay, 1 second. Let me just increase the size a little bit. So if you read the mini case, you will see that the current EBITDA is given. The current EBITDA, if I'm right, it's something like 10 million. And planning period for, the EBITDA growth rate 10%. Corporate tax rate is 30%. Depreciable life assets for depreciation purpose. Depreciation expense each year is given. Debt to asset, it is highly levered. Please remember, typically debt is only 50 to 80%. In this example, we are assuming debt to asset ratio of 80%. Annual capex required is around 40 lakhs. The purchase multiple and the selling multiple are going to be the same. This is, a very, conservative estimate. And the interest rate on debt is 12%. Typically, you get or borrow money for LBO at a higher rate, much higher rate than the normal rate. So this is, the overall interest rate on LBO. In a typical analysis, you will have different layers of debt, each carry different interest rate that need to be modeled separately. So we are going to the first part of it. What is an IRR in case of an LBO? So please look at this calculation. I hope this PPT is clear. You can see the spreadsheet. So you have the starting current year EBITDA, forecast the next year EBITDA by using a 10% growth rate. So you have the EBITDA available for the next couple of years. So now we are going to complete the analysis. So come down, you have the capex, you have the depreciation expense, interest, loan at the beginning, loan at the end, how much you can repay. This is, cash available for debt service. I will just come back to this, wait for a moment. How we arrive at the cash available for debt service. Cash available for debt service is nothing but, you PAT, profit after tax, minus your increase in working capital, minus capex. So essentially, this will give you, please look at this. You are taking these numbers. So you can see here. So the calculation is quite clear. So you are taking C14. C14 is the EBITDA minus C16. C16 is the depreciation expense minus C17. C17 is the interest. So this is essentially, your PBT. PBT into 1 minus T. PBT into 1 minus T will give you the profit after tax plus C16. C16 is the depreciation expense. You add back the depreciation expense. From the depreciation expense, you deduct, the capital expenditure. So, let me repeat. The idea is something simple. Free cash flow minus after-tax interest will give you the cash available for debt service, assuming that you are using the entire cash for debt service. That's the simple logic. There is nothing complex about that calculation. So that will give you the end of the period debt. So you have to provide, or look at this valuation. Now, at what price you are going to sell? You are going to sell this entity at 5 times the end of the period EBITDA. This is very similar to the VC valuation model because, you can't use something more complex than this. This is what we use. Or you can use, something like a Gordon's model where you assume a perpetual growth rate and a required rate of return. That can also be used. But whatever be, you need a terminal value. Now you have the terminal value. So essentially the firm's selling price minus the equity value minus the debt, that will give you the equity value. So please look at this. Firm selling price is essentially going to be EBITDA at time 5 into the multiple, that is 5. So that is going to give you this number. So this is equal to, please look at this. So this number, what you get here is, this is equal to your EBITDA at time 5 into the multiple. So you can see here. So this is going to be your EBITDA into the multiple. Multiple is nothing but 5. So you can see you multiply it with the EV to EBITDA multiple. From that, you calculate the debt. So the debt is given here. So you can see the end of the period debt 280. This 280 you deduct, you will get the end of the period value of the equity. What is your original equity investment to start with? As you can see, the original equity investment is how much you are paying. You are paying 5 times. So 10 into 5, 100. Out of 100, 90% is coming. Sorry, 10 into 5, that is equal to 50. Out of 50, 90% is coming from debt. So 45 is coming from debt. So equity investment at time 0 is 50. So that's what you can see here. So the equity investment at time 0 is 5. So therefore, your essentially, your IRR is going to be end of the period equity value divided by beginning of the period equity value raised to the power the number of periods. Raised to the power the number of periods 1 by 5 minus 1. So this is going to be the IRR. So you can see here, end of the period value of equity divided by beginning of the period value of equity raised to the power 1 by n minus n. So that is going to be the IRR. So IRR calculation is going to be this. So this is a simple way of looking at valuation here. So that is being done. So you can have a more formal way of doing it. So that is also calculated here. So you can see these numbers. It is self-explanatory. I will be sharing these sheets. I mean, as you are all familiar with the number, the calculation. So you can see that. You can see that the total return without debt, this investment is earning 20% return, but with debt, you are able to earn a rate of return of 60% per annum. So this is essentially, I mean, the leverage that you are talking about. Probably I will also take you in 1 minute to, I mean, the APV valuation. The APV valuation, what you do is you take a comparable company, calculate the cost of equity using, I think all of you are familiar with levering and unlevering, beta levered and unlevered, same way. You calculate the unlevered cost of capital. So what is there in APV? Just, I mean, I may take another 5 minutes. Is that okay, Shilpa? Okay, that's just 2 or 3 minutes. That's fine. Okay, so in an APV value, what you do is your value of the firm is equal to free cash flow to firm discounted at unlevered cost of capital plus present value of financial side effects. Or, I mean, so this is essentially what you do. So you calculate free cash flow to the firm, discount it using unlevered cost of equity, and then calculate the interest payment during the explicit forecast period and find out the present value of the same. Typically, you discount it at KD. So you discount it at KD to arrive at this. So free cash flow to the firm discounted at KU. So this is the value of the unlevered firm plus the present value of interest tax shield. So this is essentially, I mean, interest tax shield discounted at KD. So this is what you call is, I mean, present value of interest tax shield. This is, I mean, the Modigliani-Miller proposition or the simple idea. So you use this method. So this will give you an APV valuation. But normally, for most of the practical purposes, the PE valuation model or the LBO valuation models calculate only IRR, as we discussed already. So let me repeat once again the key idea here. So what you do in an LBO analysis is you calculate the starting valuation using an EV to EBITDA multiple. And then, so this is the firm value of the firm at the beginning. From that, you deduct debt, less debt. This will give you value of the equity to start with. Now, probably after n periods, you are going to sell it at, I mean, certain EV to EBITDA multiple. This is EBITDA times 0. So value of the firm, again, you estimate this is equal to EV to EBITDA multiple at EV to EBITDA multiple at time into EBITDA times 0. EV to EBITDA multiple at time, I mean, the multiple multiplied by your EBITDA at time n. So this will give you the value of the firm. So this is your original borrowing. From that, you deduct debt at time n. Of course, you have to forecast debt at time n. The difference will give you value of equity at time n. IRR is going to be value of equity at time n divided by value of equity at time 0 raised to the power 1 by n minus 1. This IRR is compared with your required rate of return. This is the simple calculation, or this is what we call is the IRR method for LBO analysis. So that is explained. And the APV method, if you are comfortable, look at the second spreadsheet. I'll be sharing this with Shilpa. Shilpa, you can probably share it with the rest of the participants. Sorry, I think we had more discussion, so that I'm not able to spend more time on the spreadsheet. That's fine. So probably, I mean, one more last point, and then we will just wind up the discussion. So LBOs makes sense when you look at or value or consider a company with stable cash flows, with lot of assets not already used for financing, and typically you have strong management teams, but they are not able to perform well during the same time period. Successful LBOs typically rely heavily on either the existing management, or they may bring a team. Most of the time what happens is they bring someone who is good infrastructure. Tax savings is an important part. Excessive leverage most of the time result in failure of LBO, like what we observed in case of TXU, like what we observed in case of this Toys R Us case. Probably I may take about 1 or 2 questions. I will share the spreadsheet, and then we will wind up the discussion. Okay.
Before that, I would like to launch the poll questions.
Okay. Yeah, please. I'll be available for another 10 minutes. So after the poll, if you have 1 or 2 questions, I would discuss that. So please, I'll be sharing the spreadsheet with Shilpa. Shilpa can share the solutions to the participants. Again, please, it is not, which of the typical is not typically true of LBO.
I'll be ending the poll now. Subro, are you trying to announce something? We can't hear you. Your voice is breaking. I'm ending this poll. I'll be launching one more poll after sharing the results. The right answer for this question is option D. R&D budgets following the creation of the LBO are always increased significantly. This is not typically true of an LBO.
Many of them have looked at, the features of LBO rather than not typically feature of. So that's why again I highlighted not was present there. Yes.
The last poll question.
Sorry, again, off is not missing there. Which of the following is not typically a driver of buyout deal returns?
This question I have asked also.
That is why now we are able to easily know. I'll be ending the poll considering the time constraint. Yeah, most of the participants have got it right. It is increase in investment in innovation. Over to Professor.
Yeah, probably I may take 1 or 2 questions. If you have any questions, please come online. You can or you can type it in the chat box.
One question I have is APV. APV is an advanced method or for doing the valuations?
Okay.
For LBO?
Okay. So I will probably take your question. Just quickly answer that. See, there are different cash flow techniques. So typically when you look at valuation, one is, the cash flow methods. Another one is the multiples methods. And the third one is what we call is the residual income valuation method using the earnings multiple. So this is it. And the cash flows, there are, one is FCFF, free cash flow, free cash flow discounted at WACC. So this is the standard that we follow. This will give you the value of the firm. This is the standard that we discussed. And the second method that we use here is FCFE, free cash flow to equity, discounted at cost of equity will give you value of equity. This is, essentially what you call is the levered cash flow or the equity cash flow. You may use equity cash flow, flows to equity, or levered cash flow. This is the second method. The third method is quite often followed, is known as valuation by parts. That is what is APV. So what is APV method? APV method again says value of the firm is equal to free cash flow to the firm discounted at unlevered cost of capital plus present value of interest tax shield or present value of site. It's not an advanced method. See, please remember these two methods are used when debt by equity ratio is fixed. So please look at our example where debt to equity ratio is fixed. So when debt is known, but debt to equity ratio is not fixed, you may use free cash flow to firm discounted. Another method is what is known as, the capital cash flow method. Capital cash flow method is nothing but capital cash flow discounted at before tax cost of capital will give you the value of the firm. So please understand what is the problem in all these methods. What is it that we are trying to do? See, you have tax advantage of debt. Tax advantage of debt, where are you capturing the tax advantage of debt? Tax advantage of debt is captured in the denominator in WACC. Tax advantage of debt is captured separately in APV. Tax advantage of debt is captured in the cash flow, in the capital cash flow method. So all the methods try to address the same question in different ways. In free cash flow to firm, the typical method, tax advantage of debt is in the denominator. As you increase debt, WACC reduces. In tax advantage of debt is captured in the present value of interest tax shield when we use adjusted present value. So it is treated separately. So value, this part is constant for firm with 0 debt and 100% debt, but this is going to capture. In capital cash flow, what you do is tax advantage of debt is captured in the cash flow. So what is capital cash flow? Capital cash flow is free cash flow plus the interest tax shield. So technically, all the methods will give you the same answer. Any other question? Of course, the application differ. If debt to equity ratio is fixed, then the suggested methods are one of these two. Typically, when you have a highly levered firm, you look at value of, the equity cash flow method or flows to equity, because the free cash flow method is not an appropriate method to value a highly levered firm. Yeah, I can see something in the chat box. Let me just open it. Okay, there is some problem. I think not something new. Anyway, I'm not able to.
One of the participant is asking on capital arbitrage.
Essentially, it is not something great. I just use the term capital arbitrage to denote. See, look at this. I will just give you an example to illustrate this point, and probably you can take it later. So what is currency carry trade? You can read about it. Carry trade is something very common. What is something known as currency carry trade? You borrow money from, let's assume, to make this example easy, borrow money from US. Essentially, the idea is borrow money from a country with a lower interest rate. Let's assume the interest rate is 3%. And invest in India. So you have to pay 3%, and in invest in India, you will make 6%. So the difference between these three is plus 3%. What standard economic theory says is, or the uncovered interest rate parity theory says is, the Indian currency will depreciate by 3%. Therefore, you are not going to make a return by doing this. If you are borrowing from a country with a lower interest rate and invest in a country with a higher interest rate, you are not going to make return because the Indian currency will depreciate. To make this example easy, if Indian is 70 now, after 1 year, it will become, say, 72.1. So that when you convert money later, you will lose money. So this is the standard economic argument.
But you can hedge it also.
But hedging will take away, typically the hedging cost will be equivalent to this amount. That is the standard economic argument. But interestingly, what you notice is in the real world, the depreciation is going to be on average less than this. So to put it differently, you borrow money from a country with a lower interest rate and invest in a country with a higher interest rate, on average, you make good return. This is, I mean, a sort of arbitrage in the sense you take money from countries where capital is available in plenty. When capital is available in plenty means valuation ratios are high. I mean, or multiples are high. When capital is scarce, the required rate of return is high, valuation ratios are low, or the multiples are low. Yes.
But you make money only when you do the hedging on that. Unless and until you do the hedging.
So technically speaking, complete hedging won't leave any money with you. If you are going for a complete hedging, I mean, it's going to be a very, very difficult exercise. Again,
because when the currency would not depreciate to that extent,
it takes a little more time to explain that, Rajiv.
Please,
I mean,
please,
you have a point. Rajiv, what I suggest you is, if you are interested in finance, you can read this interesting book, Efficiently Inefficient. Efficiently Inefficient.
Okay.
Efficiently Inefficient talks about, this is a popular trading strategy employed by hedge funds.
Yes.
So you can just read this book that carries efficiently inefficient will carry more.
I agree with you to some extent. I mean, the way partly it is hedged, I fully agree to that part.
Partial hedging will give you return. Partial hedging will give you return. Complete hedging won't leave up return.
Agree.
So that's the idea.
Professor, few participants would like to know your contact details and whether they can approach you via email.
It is okay, provided it is something very specific about today's class. I'm happy to interact, and you can share with my email ID is jijo at J for Japan, jijo at iamk.ac.in. And probably, so it's already, I mean, we crossed 15 minutes more. Let's wind up. And thank you very much for the interesting participation and a lot of questions. Wish you all the best for your future lecture series as well as an organization. You will be able to organize more such programs in future. All the best. Thank you.
So just one sec, formal vote of thanks will be given by Mr. Abraham Matthew. Just 1 second.
Yeah, Professor. So I know that you're also in a bit of a hurry to get back to your breakfast or whatever. But see, let me just say that we normally hear from professionals. So a lot of people who are professionals come to us and they they carry out the sessions with a professional approach, which is extremely practice oriented. The difference, I think, like Bhavna and a few of the others on the chat box have said, is that to hear it from an academic viewpoint brings in a lot of clarity of thought and expression, which quite often is missing in professional presentations. And that, I think, is a very big plus for us. And we thank you for what you have brought out here. What is also interesting, Professor, is that you have a complete knowledge. Probably you've been tested on this many times by your students who are a little bit more inquisitive in their thinking than we are maybe at times. And therefore, I think that you've thought through all the possibilities and you had all your answers ready, which is a great thing. Because whatever we asked, you had an answer, and you had an answer which was far beyond what we thought was possible, which I think is also a very great thing for us to experience in this session. So it also turned out to be something which is like a wake-up call for us, because early in the morning we were forced to think rather than having a cup of coffee. I think that listening to you was very informative, and it forced us to think, which I think was also a great thing for us. So overall, thank you, Professor, from all of us here at Bangalore Valuers Association and all the people who have attended for this excellent presentation which you brought to us.
Thank you, thank you, thank you for your participation. All the best for the future endeavors. Yeah. Thank you. Bye.
Thank you. Subra, you wanted to add a few words?
Yes.
Yeah.
Good morning, everyone.
Professor, you can exit.
Okay.
Good morning, everyone. There is a small announcement from membership. As you know that to avail 10% discount, to 28th February is the last date. And you have to, as a member, you can pay only 2,700. If you are a non-registered valuer, you have to pay 3,700 rupees. And few members are maybe facing difficulties knowing their to get the membership ID. If anybody is they don't know, like if like what is your membership ID, you may contact me. I can provide. And one more request is, if you are already existing member, please click on the renewal instead of the register. If a new member, please click on the register. To become the member, and we have to visit www.bangalorevaluers.org. If any have difficulties or any challenges in registration or membership ID, please contact me. Thank you. Thank you, sir.
Thanks, everybody.
Thanks, everyone. Have a happy weekend. The feedback form will be shared with the participants. Please take time to give your feedback. It will help us to improve our sessions to match your requirements.
Thank you. Thank you.